Hello, everyone. Welcome to today's webinar. This is Josh Robinson with Checkmate. It is 12:01 right now. We're going to get started here in just a minute or two. Just going to give a couple of minutes, a minute or two for folks to join us. So once again, I'm just going to give another minute for folks to join the call, and then we'll get started in our webinar on the 2020 CARES Act for Wednesday. Okay, so we're gonna dive in now and get started on our webinar. Before I do, though, again, my name is Josh Robinson. You know, many of you were attending the webinar from last Wednesday. Some of you did not attend last Wednesday's webinar. And for those of you that don't know me, I am the president and owner of Checkmate. And this webinar today is really focused on giving you all the information that you need to know about the 2020 CARES Act, specifically regarding the small business loan opportunities, the Paycheck Protection Program, and a couple of other details as well. Throughout the webinar, as you have questions, there is a Q&A. There is a Q&A option in the Zoom meeting console. That should be somewhere on your screen. Please use the Q&A option to post your questions, and I am going to have at least half an hour for Q&A questions and answers at the end of this webinar. I know I didn't in the webinar last Wednesday. I ended up going over time on the presentation and cutting short our Q&A. So today I'm going to make sure that there's plenty of time for Q&A. One other thing that I want to mention before, two other things that I want to mention before we get started. One is that during the webinar last Wednesday, and since then, you know, folks that have been sending us questions, you know, I did indicate and I promised last Wednesday that anybody who had questions that I did not respond to on the webinar would get a response from me, and that will happen. You know, with all of the craziness going on, with all these new, you know, legislation and whatnot, things are pretty crazy here right now. So I am going to get back to everybody, though, that has reached out to me with questions or reached out to your client account manager with questions. I have you know, a couple hours of my afternoon blocked off to work on this. My goal right now for everyone here on the call, my number one goal right now is to do whatever I can do to help make sure that your organizations are able to survive the weeks and months ahead. You know, our business is entirely based on the clients that we service, and without you and your employees, you know, having jobs, there is no Checkmate. In addition, you know, it's crisis time. This is a very stressful time for everyone, and you know, my number one goal in a time like this is for Checkmate to become like a life raft, where, you know, there's at least there's at least some support here that you can rely on from us in a world of turbulence and very quick movement and changes happening left and right all over the place. So that is the premise of today's presentation, and I'm happy to report that unlike last Wednesday, where the presentation was almost entirely focused on new regulations that were burdensome to my customers, today we're talking about the CARES Act, which in many ways is a way that the federal government is providing significant benefits to employers, a means of helping us survive, even if we have zero revenue happening over the next couple of months. So with all that said, the other caveat that I have before I dive in is that everything about the FFCRA, which I presented on last week, and the CARES Act, which was just signed into law on Friday, I need you guys to all understand that I am giving you knowledge to the best of my understanding. I am going out of my way to make sure that I am understanding as much detail about how these things are supposed to work as humanly possible. But this is a quickly enacted federal legislation that we're dealing with, which is never a good thing. And the fact of the matter is that we have changes happening left and right. We have folks that are speculating about stuff in some of the information that they're conveying to the world, and not exactly being clear on what they're speculating about versus what is actually drawn from the letter of the law and whatnot. So I just want you all to understand that the information that I'm providing to you is current as of this morning, and it is correct to the best of my knowledge, but at the same time, given the fact that there are no experts on any of these things right now, and the fact that we have no idea what the DOL is going to issue or the IRS is going to issue or any of that jazz. Today, tomorrow, the next day, that might contradict some of the things that I'm sharing with you right now. We can only do our best with the knowledge that we have, but we always need to, do our due diligence and consult with our experts. So if you're, for instance, in the 2020 CARES Act, there's going to be a lot of information that I'm going to share with you on what's ahead of you in so far as the loan application goes, and these are all things that you're going to need to verify or at least make sure that you're correct in your understanding when you start to work with your banker. So I need you guys, everyone on the call, just to understand that it's always advisable, to take the information I'm sharing with you here, run it by your banker, run it by your CPA, run it by an employment attorney or anything like that if where relevant. And of course, look at the details yourself. While these laws are, I don't expect anybody who's attending my webinars to read the legislation that was actually passed, unless you really are looking for something to put you to sleep. That's why we're here. But at the same time, it's always good to do your due diligence, double check what you've learned or think from my presentation. I'm always happy to, and again, give me a little bit of time to respond, but I'm always happy to take direct correspondence from anyone about their specific context and provide, a response to say, yes, you're correct. That information that you gleaned from my presentation in your specific context is right, or perhaps is not right and needs some clarification. So I want you guys to just keep in mind that this is a moving target, that the information I'm sharing with you is very current, but I can't anticipate what's going to change tomorrow. And given the turbulent situation that we're in here, it's always in your best interest to verify the things that you learn from me against some of the other sources that you lean on for expertise when it comes to the advisors who help you run your business. So with all that said, here's our agenda for today. So we're just going to go through a quick intro, similar to what I covered in last Wednesday's presentation, and then we're going to take a deep dive into some of the details on the CARES Act, in particular the Paycheck Protection Program. Then I am going to give a quick update on some of the activity happening here on the Checkmate side in support of the FFCRA for all of our customers, the new time off categories we're creating, the new earnings codes and whatnot. And then finally, we'll have at least a half an hour, if not more, for Q&A at the end. Before going any further, we have another webinar scheduled for Friday, April 3rd at noon. And following this webinar, everybody who's on the call will receive a copy of the recording of today's webinar, and you will also receive a copy of the PowerPoint that is being used here for the webinar. So the URLs that I'm sharing here, you will be able to click on these once you have a copy of the PowerPoint. But the webinar that we're going to do on Friday is sort of going to be a hybrid of last week's webinar and today's webinar. But there is going to be a fair amount of new information that I'm going to share in regard to, for instance, I'm actually going to go into some details on Friday of exactly what Checkmate has done, to date to apply for our own paycheck protection loan and our own economic injury loan. I'm also going to provide, again, another update in a little bit more detail on the time off categories and earnings codes, but more specifically, I'm going to provide some guidance on how we will be handling the processing of the FFCRA tax credits for our customers. We're also going to cover an update on the processing of the employer taxes, how that will work for employers who are not participating in the Paycheck Protection Program and therefore are able to defer payment of the employer FICA taxes, or at least, the Social Security taxes until 2021 or 2022. And then guidance and resources on preventing coronavirus in the workplace. For those that are essential employers already, you already have people that are still in your workplace, and for those that once they open back up, will have a need for preventing coronavirus in the future. Again, once everything is back up and running, we are not going to be in a world where coronavirus is not still a problem. So there will need to be active measures that we're taking within our businesses to limit the exposure that we have going on in our businesses to any of our staff to coronavirus. So I'll be covering a couple of details and things to be concerned about or consider in regard to preventing coronavirus in the workplace during our webinar on Friday as well. And again, everybody will be getting a copy of the presentation, so you'll be able to click on the link, the register here link. And everybody who's on the webinar now should have also received the email that went out on Monday, which also provided you with a link to register for the Friday webinar. So what has happened so far? So the first thing, of course, here was, legislative-wise, was the Families First Coronavirus Response Act and its impact on employers. And I want to take a minute to talk about this because, as I've been having numerous conversations with customers, there have been a number of instances where in these conversations, customers have given me some insights that they knew about that I was not aware of. And in this case, I was talking to a customer yesterday, and, I previously had been saying that when the reason why an employee is not working is because you do not have a job for them to perform, that would not be a qualifying reason or a reason that you would be obligated to pay them for their emergency paid sick leave. And that is generally true when you are an organization who's in a position where you have to lay off all of your people at a location or all of your people within a department or things of that nature. However, if the reason why your business is closed is because of a state-mandated quarantine or state-mandated shutdown, if you will, then that is a COVID, that is a qualifying reason that you would be able to pay your employees or even required to pay your employees under the emergency paid sick leave provision of the Families First Coronavirus Response Act. that would be a reason through which you could pay those employees for their 80 hours of emergency paid sick leave. Previously, I had told you that you would be in that position. If there's not a job for them to perform, then you need to furlough or lay them off, and they'll collect from unemployment. And that is still available as an option to you. However, you could pay folks for emergency paid sick leave employee leave and receive your corresponding tax credit for that cost. If the reason why you're not open is because of a state mandated quarantine. So that's just a point of clarification that I want to add, and it's just another example of a situation, that came to light through a conversation, and it makes sense. It makes all the sense in the world that would qualify. Again, just for clarity, the thing I'm clarifying, the thing that I'm trying to make clear for everyone is that where I previously said if you don't have a job for them to perform, you need to lay them off or furlough them. Now, my new guidance here is that if you don't have a job for them to perform because you've been shut down due to a state quarantine, you could pay out the 80 hours of emergency paid sick leave employee pay to your staff because it's COVID related. Their inability to work is basically a quarantine related inability to work that was thrust upon you by the state. It isn't. I don't believe that it is mandatory for you to do that, but you can do that, and you can get your tax credit if you choose to do that. If you do not pay them the emergency sick leave, because you were shut down by a state quarantine, or the state has prevented you from doing business. Once your employees, if you furlough or lay them off, once your employees come back to work, you then have the obligation to pay them up to 80 hours of sick leave for employee or for COVID-related sick leave for the employee's own purposes at 100% pay once they are back working for you. If they don't use all of their time in the context of what I just described as, the first 2 weeks of your shutdown or the first 2 weeks of your shutdown post 4/1, you could pay out your emergency sick leave employee pay. And then once you're back up and running, there would be no bank for them to draw from for that particular time off obligation for the rest of the year. So just a little point of clarity there. I hope that was a point of clarity rather than further confusing. Next, the next development is the emergency expansion of unemployment benefits at the state level and the federal level. And as a result, we have millions of people, well, not as a result, even without that, we have millions of people applying for unemployment benefits. I'm sure most people have heard the news headlines. Last week, the number was something like 3.8 million. I think they're expecting this week's number to be somewhere in the 5 to 6 million range. With the CARES Act having passed on Friday, that does come with some significant enhancements to the unemployment situation as well. As some of you may be aware, there's a provision within the CARES Act that now adds up to $600 of additional weekly benefit amount for employees that are receiving unemployment benefits. Basically, the gist of this is that the federal government wanted to make it so that those folks who are receiving unemployment benefits at least for 4 months were receiving close or an equal amount to what they're used to receiving in their paycheck as unemployment benefit compensation for at least 4 months. So there's this provision that adds up to $600 per week per unemployed person that is funded through the federal level that they can now receive in unemployment benefits, and that lasts for 4 months, which in that context, it's beneficial to employers because the state Department of Employment Security has already determined that any unemployment claims that are made by any of your staff during this time frame are not going to be charged against your employer account. even if you are a reimbursable employer. So there is, the only reason why usually an employer would have any reason to be concerned about what's happening between their former employee and employment security generally is because, the unemployment claims paid out to your former employees are chargeable against your account, which can increase your unemployment rate over time. But because there's no negative impact on your unemployment account related to unemployment claims happening during this coronavirus crisis, then it just simply means that your decision for terminating, doing a layoff versus doing a furlough is purely one that is what makes sense for your organization. And whatever makes sense for your organization is how you should pursue your path forward with layoffs or furloughs, because the benefit amount that the employee gets is going to be between them and employment security, and it's going to have no negative repercussions for you as the employer. So that just makes it so that you don't have to be as concerned about those notifications you're getting from employment security about the unemployment benefits they're issuing to your former employees, given that it won't cost you in the long run. And as you are all aware, we have forced closures of many businesses happening via state mandate. We have the voluntary closures of even more businesses. We've got the schools and daycares, closing, causing your employees to not be able to perform their essential duties. And then, of course, we have the new government mandates like the FFCRA. And now, finally, we have new lending and loan forgiveness programs and tax deferment options, which will now be a saving grace for many of you who are on this call that might give you a lifeline to allow your company to exist in a world where it otherwise would have gone under due to this crisis. So the core, the biggest part of the CARES Act that is impactful to employers is the Paycheck Protection Program, and the Paycheck Protection Program is a loan that is done through the SBA, and it's called what the SBA calls a 7A loan. That is the standard kind of loan that the Small Business Administration issues through local banks. And in this case, the Paycheck Protection Program provides loans of up to 2.5 times your average monthly payroll cost. And the idea here is that, as you'll see in a minute, I'll get into the details on how you determine the average monthly payroll cost. But the idea here is if we take the average monthly payroll cost times 2.5, and then we say that all of this money, this loan that you can get, which is 2.5 times your average monthly payroll cost, the idea is that will be money that you will be using to fund your payroll for 8 weeks. And the 2.5 times multiplier allows us to account for, small, changes in your workforce that have happened since the time frame during which the average was calculated. So the idea here is to take that average monthly payroll cost times 2.5 and to say that reflection of 2.5 months of payroll cost is now going to be used in the form of a loan from the federal government to your company to fund your payroll for 8 weeks. And the loan, the Paycheck Protection Program, are federally guaranteed loans. There are no personal guarantees or collateral required for these loans. So what is considered in determining the payroll cost? When we talk about the average monthly payroll cost, what are we talking about? So the items that are included are all forms of compensation, the payment for vacation, parental, family, medical, or sick leave, and the allowances that you've given for dismissal or separation, so severance, the payment required for provisions of group health benefits, including insurance premiums. So this would be, allow you to take into account both the employee and employer side of the cost of the health insurance. The payment of any retirement plan benefits, and in this context, again, the relevant part is the employer match on or contribution to the 401k, 403b, or whatever type of retirement plan that you have, and then the payment of state or local tax that is assessed on the compensation of employees. For instance, SUTA tax can be accounted for when we are talking about your total payroll cost here. So what costs are not eligible for payroll? Any compensation that is issued to employees during the period of time in which you've calculated your average, any compensation issued to any employees or owners greater than $100,000. So basically the way that you need to look at this is over the entire span of time for that the average is calculated on, the maximum total amount of earnings that can be accounted for any employee is $100,000. Any amount over that has to be disregarded in your calculation. Now, there's quickly enacted legislation often has things in it that don't make any sense, and this is one. So the costs, so the legislation literally excludes from when we calculate your average monthly payroll cost, we cannot include the cost of the employee or employer Social Security or Medicare taxes or withheld income taxes. So those numbers have to be excluded. In essence, we have to take gross comp less Social Security, Medicare, and withheld income taxes when we are calculating the cost of payroll for the average monthly cost of payroll purposes. And again, it makes no sense, but that's what the rule says. We also cannot take into account any compensation for any employee whose principal place of residence is outside the U.S. And then we have then once we know what our calculation for the cost of payroll is, we can then determine that average monthly payroll cost. And this particular item is something that is currently open for debate. I've read in a number of places that the calculation of your average monthly payroll cost is actually, includes the period of time from the day immediately prior to the disbursement of the loan and 12 months prior to that. Which itself doesn't make sense because you need to, how can you base your average on the day before the disbursement of the loan when you don't even know if you're going to get the loan to begin with? You have to apply for the loan first. But in any case, right now there is a debate going on about whether or not your period of time for your average monthly payroll is 4/1/19 to 3/31/20, or if it is the prior calendar year. So I've had a couple of conversations with some folks that indicated that they think that the calculation needs to be based on average monthly payroll costs for 2019 as opposed to the period of time immediately prior to the disbursement of the loan. In any case, that's why the asterisk is here for right now, is because that is open for debate, and this is something that you're going to need to get clarity from your banker on. So, as I said, for employees earning more than $100,000 in the time frame, you can only include the first $100,000 of their comp. So, for seasonal businesses, the average monthly payroll cost is determined using 2/15/19 to 6/30/19 as your time frame. Again, I have no idea why. That seems like it was just pulled out of thin air. There are seasonal employers out there that don't have any employment during this time period. So, how are they supposed to determine their average monthly payroll cost? Again, these are things that you're going to have to run by your banker as far as how you run these calculations if you happen to be a seasonal employer, because the regulation or the rules right now are not clear. So all of the money that you're given, the 2.5 times your average monthly payroll cost, all of the money that you're given through this loan program must be used by 6/30/20. And there are specific criteria that once you meet them will result in the forgiveness of this loan. So you could very well be in a position where the government, provides you with 2.5 times your average monthly revenue in the form of a loan, and then 100% of that is made to go away through loan forgiveness, as long as you adhere to certain rules around staffing levels or salary levels. If you do not get forgiveness on 100% of the loan, then the payback on the loan is deferred for the first 6 months, and you could get up to 12 months deferral on the payback of the loan if any of it was not forgiven. So basically, loan forgiveness is, and it's not exactly like this. I'm actually going to show you the details on loan forgiveness. I forgot to delete this bullet point. It's more complicated than this, and your eyes are going to water when you see the details. But the gist of it is that if you maintain 75% of the employees that you employed prior to 401, and you maintain pay levels, approximately 75% of what they had been historically, then the loan would be forgiven after 6/30. But there's technical details that you'll see why is enough to make your head spin. But you'll see why. This isn't entirely inaccurate, but it's a simplification, a serious simplification of the rule. So the Paycheck Protection Program is eligible to small businesses and 501c3 nonprofits with fewer than 500 employees that were in business since February 15th, 2020. Loan proceeds can be used for payroll costs. They can be used for the costs related to the continuation of group health plans. They can be used to cover the costs, of course, of employee salaries, commissions, or similar compensation. The proceeds can be used to pay for interest on any mortgage obligation, but it does not cover you for prepayment or for any payment of principal. It includes, you can also use the monies that you receive under the loan program to pay your rent. And again, regardless of what you use the money for, as long as you have met the obligations for forgiveness, then it won't matter what you've spent the money on. If you get the loan forgiven, it also won't matter what you spent the money on if you don't get the loan forgiven. You'll just have an interest rate that you have to pay. And utilities can also be paid with the money from the Paycheck Protection Program. And finally, interest on any other debt obligations that were incurred before the covered period. So not principal, but interest on any other debt obligations. So, if you have any company loans out there, the interest on such loans can be paid for through Paycheck Protection Program money, but not the principal. So loan forgiveness, how do we get, once we receive our Paycheck Protection Program loan, how do we make it so that we never have to pay that loan back? So then this is going to be enough to make your head spin. I didn't have the time to, make the language here more, worded in such a way that regular folks can understand. A lot of what follows is like IRS language. But basically, the forgiven amount will be equal to the amount actually paid for payroll costs and all of those other things, the legitimate things that you can use this money for, during the 8 weeks following disbursement of the loan. And additional wages paid to tipped employees under Section 3M2A may also be forgiven. I'm going to be looking into the details behind that, because I don't know why they wouldn't have been forgiven. Oh, probably because, this would probably be like cash tips or something like that. But I'll have more news a little bit further down the road on how tipped wages come into play for this, for the amount of the loan forgiveness. The forgiveness amount is subject to a reduction if there is a workforce reduction or a reduction in the salary or wages of an employee. So the way this is designed is pretty much assuming that the Paycheck Protection Program loan will be forgiven. And so the amount that will be forgiven is going to be reduced if there is a workforce reduction, or reduction in salary or wages greater than a certain amount. Okay, so the amount attributable to the workforce reduction, meaning the layoffs, if you will be equal to the initial forgiven amount multiplied by the quotient of average FTEs during the 8-week period divided by the average FTEs for the period from 2/15/19 to 6/30/19, or Jan 1/20 to February 29th, 2020. So basically, you have the option of picking which of the periods to use in the calculation to determine, whether or not you had a disproportionate increase or decrease in the number of FTEs or individuals employed during the period in which the loan had been received and was intended to be used. And the amount attributable to a salary or wage reduction is going to be basically if you reduce salaries by more than 25% from the most recent full quarter. So that would be the full quarter ended 3/31. So if you between 4/1 and 6/30 reduce people's pay greater than 25%, then you will not qualify for 100% forgiveness of the PPP loan that you receive. So this next item is related to something I've been getting a lot of questions on. Okay, sorry. So right now, a number of employers are in a position where you have already let go some of your people. And the whole point of this payroll protection program is to make it so that you keep your people on payroll. So the idea here is that any reductions in workforce salaries or wages that occurred between 2/15/20 and 4/26/20 will be disregarded for the purposes of reducing the forgiveness amount, so long as those reductions are eliminated by June 30th, 2020. So again, if you've already let go, many of your employees, as long as you bring them back onto payroll sometime between 4/27 and 6/30, you will the fact that you had let them go before you had the Paycheck Protection Program loan in place will not have a negative impact on your ability to get your loan forgiven. So when it comes to forgiveness, you're going to need to apply with the lender who's servicing your loan. FYI, these loans are available not just through the banks that have historically been SBA partner banks. Basically, any bank under the sun is able to provide these government-backed loans. But at the end of the day, if there's anybody on the call that needs a recommendation for a banker, I'm more than happy to suggest a couple of folks. Just shoot me an email and let me know, and I'd be more than happy to connect you with a couple of people who I have a lot of respect for. And then once you apply for forgiveness, the lender has 60 days to review and make a determination. And any portion of the loan that is forgiven, this last sentence I interpret to mean that any portion of the loan that is forgiven will be excluded from gross income, meaning that it is not considered gross income to the company. It is considered to be, in essence, not taxable income, to the company, like it would be if it were revenue you're earning from a customer. So for the Paycheck Protection Program, given everything that I've said, here's a couple of other details. We right now have a situation where the federal government has issued this new law through which there's $349 billion set aside for small business loans. This is being administered by the SBA through the private lenders that the SBA works with throughout the country. The SBA itself was never designed or equipped to handle the kind of volume that they're dealing with right now. Additionally, the bankers are completely drowning right now because this opportunity applies to almost every single one of their banking customers. So in order to make sure that you can get everything in place as quickly as possible, given our reality, I just have a few suggestions on what you can do right now. So firstly, contact your banker. Talk to your banker. Tell them that you are planning to pursue a Paycheck Protection Program loan. On that note, for a second, there is no obligation that you have to take the loan once you know how much you can get. So again, the idea of not applying for the loan, you might want to rethink that if you're thinking that you might not apply for the loan because there's no obligation to take it. And right now, there are so many applications that are flowing through that you have until June 30th to apply for the loan, to receive the loan, to use all the money in the loan to pay your people. You have until June 30th. So contact your banker now. Word on the street is the actual PPP loan applications are going to start to be accepted on Friday. So contact your banker. While you're waiting to get news from the bank on exactly what you need to do, I would highly suggest that you make sure you have a current personal financial statement and have copies of your previous year's corporate tax returns. I would suggest the 2018 return and 2019 if it's ready. I don't think you need to go back further than that. And these would be, the corporate tax returns. When I applied for the economic injury disaster loan, the system required me to upload my corporate tax return, but all I had to do was give them permission to go to the IRS and pull my personal tax returns. I didn't actually have to provide my personal tax returns. So right now, I don't think that you need to be overly hung up on, getting copies of all your personal tax returns, but you should definitely have easy access to the corporate tax returns so that as soon as your banker is ready to move, you give them all the information in one fell swoop and make it happen. So the next item is completing the PPP application. So regardless of the bank that you're going to work with, there is a universal PPP application that is now available. And it's a pretty straightforward application. And this is going the government is going to start accepting these forms, these applications, if you will, on Friday. You need to work with your bank on getting them the details they need in order to do what they need to do on your behalf. But this application form itself, I see no harm in completing it now and sending it to your banker so that they have it on hand as soon as the applications can be submitted. So the Paycheck Protection Program application form is available here now. There's a link to it in our presentation. And again, in addition to contacting your broker, preparing your current financial statement and prior year corporate returns, this is one of the few things that right now you can do while we're sort of in a holding pattern. And then lastly, you can prepare a report to back up your average monthly payroll cost calculation. Now, a number of customers have reached out to me to find out if we can assist with that, and yes, we can. I need to create the version of this report that will calculate average monthly payroll cost for one of our customers this afternoon. then I'm going to work with the implementation team, and we're going to copy and paste that report from the company we build it in into every one of your client accounts as well. So in the very near future, everyone will have within your client account, and when I say the very near future, I mean, by Friday morning, everyone will have in your client account a report that is showing you the average monthly payroll cost, accounting for all of the items that I indicated need to be included in the cost analysis, and excluding all of the items that I indicated can't be included in that analysis, so that you can easily use that report to send it to your banker along with your loan application, and get everything flowing as quickly as possible. So with that all said, I now want to cover a little bit of details on the economic injury disaster loans and the emergency economic injury grants. And in particular, in the webinar last Wednesday, I spoke about the economic injury disaster loan, and I did apply for one of those for Checkmate before the Paycheck Protection Act or program existed. And I am still pursuing that, just to see what the loan program involves and what benefit we might be able to get from it. The gist of it is that there are no forgivable loans as part of the economic injury disaster loan program. However, you can get up to $2 million at 3.75% in lending through the program. But the thing I want to touch on right now is whether you're doing the Paycheck Protection Program or you're doing a traditional or formal economic injury disaster loan, this $10,000 advance is available in either situation. So right now, you could go onto the SBA website and apply for the $10,000 economic injury disaster loan advance right now. And when you apply for that right now, there are fields at the end to identify your bank account number and routing number. Now, I did this just yesterday. I do not know how long it will take for them to fund my account. But I'm cautiously optimistic that I might see the money by Friday. Cautiously optimistic, but not naive. The link to apply online for the economic injury disaster loan advance is listed here, and I had to submit this new application for the economic injury disaster loan advance yesterday from start to finish as if I had never applied for an economic injury disaster loan to begin with. That said, it was not nearly as onerous as the first application that I submitted. It's very, very streamlined, and it's all web-based now. So the SBA seems to have gotten their act together, at least insofar as how they're accepting applications for this emergency grant. And the emergency grant is also, basically will be absorbed into the forgivable amount of your PPP loan once the full loan amount is determined and issued. So then this next bullet is simply, more about the economic injury disaster loan program in general, but not specific to the grant. So there's also an impact on retirement plans, and this is important for those of you that have folks on staff that are either currently working or perhaps laid off or furloughed. Rather furloughed mostly because the laid off folks. Well, you probably would want to communicate. Actually, the laid off folks, I'm not sure how they will have to deal with this. They would have to work with the custodian directly. But for the furloughed folks or those still on staff earning payroll, the CARES Act provides for coronavirus distribution, which is exempt from the 10% early withdrawal penalty. And this distribution can be paid back to the plan over a period of 3 years, and it can be done without any regard to the actual plan-specific contribution limits. And and then, you know, if they do take this distribution, because as most of you are probably aware, your contributions to 401k or 403b are not taxable for federal income tax purposes at the time that you contribute. They're taxable when you realize, you know, the money, if you will, which in this case would be through the distribution. So when the employee receives the income through a distribution, it is taxable income, which would be reported to the IRS in a 1099-R from the retirement plan custodian. And the extent of it that's not repaid over the 3 years, again, this is all going to be between the custodian and the employee. Would potentially have taxable income, you know, there for the employee for a period of as long as 3 years. Such distributions generally may not exceed $100,000 in total for an individual. So again, your employees now who qualify, and there are rules, can take as much as $100,000 in an early distribution as if they were of age, with no downside repercussions to the employee at all, until they, you know, there's any balance that remains owed after a 3-year period. So in addition, there's also some new details about loans. So the CARES Act provides for a temporary increase on the plan loan limit to the lesser of 100% of the participant's vested balance, or $100,000 for loans made during the 180-day period following the enactment of the CARES Act. And then it also allows the delaying for an additional year of any plan loan repayment that comes due during the period from enactment of the CARES Act and ending on 12/31/2020. Any subsequent repayments must be readjusted to reflect the delay in due date and any accrued interest. So it's not omitting the interest charged, but it's simply saying that you now can enable your employees who have 401k loan deductions happening through payroll, you can enable for them to shut those off through 12/31/2020, and then through basically the custodian would have to recalculate the total amount owed, and we would have to reinstall the scheduled deduction accordingly for all pay dates after 12/31/2020 for loan payments on 401k. And both of these are part of the CARE Act, and neither of these provisions require or obligate you to have any other, you know, involvement with other acts of the CARES Act. So, you know, whether or not you participate in the Paycheck Protection Program, these new conditions for the retirement plans apply to you. So a couple of additional resources here. We've got a really good website with the Department of Treasury that they just put up the other day. And here you have basically a link to the application for the Paycheck Protection Act loan. You have also, if you are a borrower, some good resources here. Details of things to take into account, much of which I covered in this presentation provided by the Department of the Treasury there. We also have, for additional resources, the SBA website, which again seems to be back up in business, which has, you know, a lot of information out here in regard to your economic injury loans and loan advance. If you want to apply for the $10,000 grant, that my hope is that I'm actually going to have money in my bank account on Friday, and I'm going to report back to everybody to let you know if that actually happens. But you clicking this link at the top, this is the streamlined application process. It is now an online application process. It is not a download this form and fill it out and then upload it back into the system, at least insofar as applying for the $10,000 grant. So I highly suggest that anybody who's going to take out or request the Paycheck Protection Loan, seriously consider whether or not you should be applying for this $10,000 as well. My philosophy on this is why not? You know, I don't see any harm in it, so I just jumped through the hoops and got it done for Checkmate a couple days ago. So with that all said, we are getting down to the end of my presentation. So what I'm going to do here is I'm going to go into Q&A, and if there are more questions, please do type them in. I'm happy to take questions that are related to FFCRA if people have those as well. But I'm going to dive into the couple of questions that we have here. So, question number one. All right. So, how concerned should we all be of the money being scooped up by bigger companies? So that's a very good question, and my thought here is that you should be very concerned. There is, you know, while the CARES Act has set aside $349 billion for this paycheck protection program, and the large companies, those with more than 500 employers, everything that's in the CARES Act for them is all being managed through the Fed, and that has $500 billion dedicated to it. That said, there are millions of businesses that are all about to go bankrupt right now, and you can't assume that the money is going to be there when you go to apply for it. Everybody needs to be applying for this now. This is why I suggest get all of your documents together. Fill out that application even though your banker hasn't sent it to you yet, so that you have it ready to give them as soon as they can accept it. You need to be the first in line to the extent possible, because there is no guarantee that you're going to get that money. You know, I do not think $350 billion is enough. You know, or rather, I think that there are so many businesses that are going to take advantage of this because there's really no rules around proving that you have, you know, incurred some sort of injury. You know, so a company that has, you know, 1,000% profit margin can get this loan just as easily as somebody who is literally going under right now. Therefore, everybody needs to apply for these loans right now. If you don't do this right now, even if you do this right now, you might not be assured that you're going to get your money. But if you don't do this right now, I can guarantee you won't get your money because you won't have any application flowing or being processed. So I do think that's a very legitimate concern, which is why you need to act now, which is also why if anybody on the call, you know, has concerns with the bank that you work with now or your banker, if you send me an email, I'm happy to make a couple suggestions of bankers who I've worked with, who I think very highly of. So then next question. Per the current terms of the PPP, loan proceeds can be used to pay for employee-related expenses, including group health care benefits and insurance premiums. As you currently understand it, does this include workers' comp premiums? As I currently understand it, no. I have seen no reference to workers' comp premiums or any non-benefit related cost. So that's a very good question. I would certainly think that it should be usable for that purpose, but it has not been specifically called out. So I'm making a note on that one because we are putting up a web page for all of this, which is going to have a very detailed FAQ section, and I'm going to make sure that I get a good answer on the workers' comp question. Right now, to my knowledge, workers' comp premiums are not a legitimate expense to use this PPP money for. All right, so unemployment of federal $600, is it on top of the amount New Hampshire does weekly? You said up to $600 a week, but that is not what is being quoted by the government. Okay, so yeah, I guess to the extent that what I'm saying is misaligned with what you're hearing from the government, that would definitely be something that I would need to know a little more specifically what you're referring to there. But the unemployment so basically there is language in the CARES Act. There are sections of the CARES Act that specifically speak to the fact that there is an additional up to $600 per week of unemployment benefits that will be provided to employees receiving unemployment benefits for the purposes of ensuring that they receive 100% of their normal compensation amount while they are unemployed for 4 months. I forget if it says beginning on 4/1 or what, but for a 4-month span of time. And there was a lot of this is what almost caused the CARES Act to not get passed by the Senate. And it is there. So at the end of the day, what I do know for a fact, the $600 perhaps is where there's some confusion, but I do know for a fact that there is additional extended unemployment benefits funded by the federal government that will increase the weekly benefit amount that your employees are entitled to receive, or your former employees are entitled to receive from employment security, that can get up to $600 a week above and beyond the normal benefit that the state would have given them. And it's up to $600 a week. It is not, a guaranteed $600 a week. And I do believe that the up to $600 a week condition is in very limited circumstances. I do not believe that is intended to be applicable to the vast majority of people. But some increase beyond the weekly benefit determined by the state is going to be added to the benefits that they're receiving, that's now being funded in part by the federal government through the CARES Act. Okay, so next question. We had a material change to our payroll around October 2019 due to an acquisition. Getting new staff on board, using average from April 19 to March 20 will not reflect their future payroll outgoings correctly. Yeah, I was just actually having a conversation this morning about this, and this is the conversation I was having this morning was when somebody made me aware of the fact that they understood the period for your average payroll calculation to be the calendar year 2019, and I right now I have not seen any language that speaks to that, but I have heard at least one person who is a well-informed person tell me that they think that's the situation. I still do believe, because the language of the law states that the period of time for the average is the period of time ending immediately before the disbursement of the loan, which would indicate to me that it is not calendar year based. But yes, it does. The way this Paycheck Protection Program works is it does not take into account your future projected payroll needs, with the exception there being that the multiplier of 2.5 times your average monthly payroll cost is intended to inflate the loan amount beyond 2 times monthly payroll cost, because the loan itself is meant to cover you for 8 weeks, but the multiplier is 2.5 times. So it is designed to, in some part, account for the fact that your average monthly payroll cost might not currently be a reflection of what your next month's payroll cost would be, but it certainly doesn't, it doesn't do a huge amount of favors for you, being in a position where you've expanded the workforce like that. I believe that your avenue to a solution is to pursue an economic injury disaster loan in addition to a PPP loan, or some other variation of a SBA 7A loan in addition to the PPP loan, because the PPP loan money will not take into account the extra payroll costs that you're going to be paying out. And based on the wording of how all of the details that I've read are supposed to work, there's no consideration. There's nothing included in here that speaks to this at all. And I definitely think that is an oversight, an unfortunate oversight. And I have no belief right now that they would do anything to fix that oversight, given the fact that right now everybody is scrambling around like chickens with their heads cut off trying to figure out how to enact the law to begin with. So next question is, our U.S. company is 100% owned by a U.K. limited company. Can we apply? Good question, James. And yes, and I will call you offline to talk about this. So I do believe that I have not read anything that indicates to me that a U.S.-based company or a company that has a U.S. presence but is owned by a company that is based outside of the United States. I have not read any language yet that would exclude the domestic company owned by a foreign corporation. And in this case, you have to have a TIN because we have to pay your employees employment taxes. You would have an employer ID number that we're paying your employees' Social Security, Medicare taxes, and federal income tax through, which would be the ID number that you would use in your application. But right now, James, I'll talk to you offline. I'll give you a call this afternoon, probably around, well, actually, I'll email you separately so that we can coordinate because you're 5 hours ahead. So I might not be able to talk to you until tomorrow morning. But we will talk this through. It's a very good question, and it's one that I do not want to misspeak about here by speculating about anything. If there's anybody else on the call that question applies to, these questions that have come up that I'm unable to answer, I'm going to make sure that everyone on the call actually gets copied on the email that goes out with those answers provided. So is the PPP based on need? No. The PPP is not based on need in any way, shape, or form. This is why I'm encouraging everybody on this call. We only have like 3 customers that have, maybe 5 customers that have more than 500 employees. Everybody on this call, with the exception of those that have more than 500 employees, apply for a PPP. If you do not apply for a PPP, you're walking away from free money. Now, I am not one to advocate for, vast and huge government expenditures. I am a fiscally conservative person by nature, but apparently I am one of the few remaining of us because, or at least there are none at the federal level anymore. And in a world where the government has now, developed this law, the whole point of this, as far as I'm concerned, is to give a lifeline to companies that literally would go bankrupt right now if the government didn't do this. And for those that aren't in that circumstance, the fact of the matter is we are all suffering. Any way you shake it, in one way, shape, or form, we are all suffering from the situation related to coronavirus. And even if your bottom line isn't hurting right now, who knows what's going to happen a week from now, 2 weeks from now, 3 weeks from now. You're taking out of the PPP loan, and your desire to get forgiveness on that loan will ensure that you will keep your people employed through 6/30/2020, at which point the government seems to think that this need to keep people employed won't be so prevalent anymore. But you're taking out the PPP loan. In some ways, you could look at it as a patriotic thing to do, because if you don't do that and then you run out of money and then you can't employ your people anymore, now you're laying everyone off. They're going on unemployment. They're increasing the amount of unemployment liabilities being incurred, and they're defeating the purpose of what the PPP was intended for altogether. So I highly suggest, I think it should be a very rare circumstance when somebody chooses not to participate in the PPP. That said, before I move on to the next question, there are some conditions that are also applicable if you do not participate in the PPP, which I want to make folks aware of. If you do not participate in the PPP, you do have the ability to defer until 2021 and 2022 payment of your 2020 employer-side Social Security taxes. Now, based on the language I read, it does appear to be only Social Security taxes, only the employer side of the Social Security taxes, and not the Medicare tax. But you could, if you do not participate in the PPP, you can defer the payment of your employer side Social Security taxes and not pay a dime on that for the rest of 2020, and then you would have lump sum payments due at specified due dates in 2021. When I do the webinar on Friday, I'm going to speak more to these situations. For employers that are deferring their 2020 employer Social Security taxes, here are the rules you need to know about, et cetera, et cetera. But I did want to mention that briefly because that is, for those that choose not to participate, that is something that you can do. But right now, I don't see any reason why everybody isn't applying for these loans. You should just apply for the loan, I think. So did you address the payroll tax credits? So that's payroll tax credits is FFCRA. I did cover that in the Wednesday webinar last week, and I will be speaking in detail about the payroll tax credits in the webinar on Friday. But Daria, I will call you this afternoon because I owe you a phone call, and I will talk to you directly about the tax credits if you're available. I'll give you a ring here probably around 2:30 or 3 this afternoon. The gist of it is right now, just for everybody who is on the call, I am still in a figuring it out process right now on exactly how we are going to make it so that when you incur the cost of the emergency paid sick leave or the extended FMLA, that you are able to actually reduce your 941 tax liability as soon as humanly possible, if not in the current payroll. That is my goal, is to make it work like that. Our software provider, Kronos, is still doing things development-wise to put in place the functionality that they're intending to, and our tax software vendor is doing the same. My intention here, depending on exactly how these software providers are doing their stuff, if I need to, I am intending to figure out how to provide through a manual process a solution whereby your current period 941 tax liability is actually reduced dollar for dollar by the emergency sick leave obligations that you've incurred in that payroll to the extent that I could reasonably do that. So that's my goal, but I will have more news on Friday exactly about how the tax credits will be processed. And Daria, I will call you this afternoon. Okay, so then we received a statement from our legal team stating we can simply delay payroll taxes. How and when would this be done? It doesn't seem to be a defined PPP loan. Yeah, so this is exactly what I was just speaking to. It allows employers to defer payment of the employer share of Social Security, pay those taxes over the following 2 years. This provision should allow many companies to preserve cash needed for other purposes and repay that liability over time. This is true. And so the equation you need to figure out is the maximum amount of the PPP loan that I could take out and have converted into a forgiven loan, and therefore have no actual cash obligation to pay back. Is that going to be a larger benefit to us than the deferment of the employer side Social Security taxes, pay period by pay period, from 4/1 through 12/31/2020? Are we going to get a bigger benefit from the one fell swoop, cash grant, if you will, or are we going to get a bigger benefit by not taking that cash grant and deferring our employer Social Security cost? In essence, what you should look at is the way you should look at this is free money on the PPP side for a forgiven loan versus a 0% interest loan on your Social Security tax that you're deferring over, pay period by pay period into the payments that you're going to make in 2021, 2022 to make up for the deferment. So basically, there's no penalty on delaying those payments that would have otherwise been due, but the the opportunity cost that you need to figure out is, would that generate more benefit for your organization than the PPP loan would if you can get that PPP loan converted into a grant? So yes, so the employee retention credit. Thank you, Darlene. That is a very good question, and yes, it will touch on the employee retention credit. But just to speak to that for a moment, the details of the employee retention credit are basically you need to retain approximately 75% of your employed individuals and or 75% of your salary levels that were used in determining the average monthly payroll cost through 6/30/2020, and as long as you do that, then the loan will be forgiven. That does mean, just to be direct and answer the question that some of you might be thinking about, and I think usually extreme examples are a good way to test, the parameters of how these things work. But technically speaking, if you take out a PPP loan and you spend all of that money by 6/30/2020 to pay all of your staff, and perhaps throughout you reduced your staff or decreased salaries by 25% or so, and then on 7/1 you lay off your entire workforce, you will be able to get your loan forgiven. So let's see, and I will touch in more detail. I will touch, Darlene, on the specifics of when I say, approximately 75%, I will touch on the specifics on Friday of exactly what you need to maintain, because, of course, the language was written by lawyers and I think actuaries based on how the language is written. And the two paragraphs that describe how what the conditions you need to meet in order to not avoid having your loan not forgiven are kind of detailed. The nice thing is that if you don't meet your obligation, if you don't adhere to those 75% or so requirements, it's not that your loan will not be forgiven entirely. It means that a prorated amount of your loan will not be forgiven. So it's not black and white. If you end up decreasing your staff level by 30% between now and 6/30, you will only have a small amount of the loan that's not forgiven. Whereas if you decrease your staff by 75% between now and 6/30, you'll have a very large part of that loan that's not forgiven. But you would still have a part of it that is forgiven, because you did maintain some of your employment through the period of time required. So if I'm approved for a PPL, will the government reduce? Oh, sorry. The other one was the form for PPP states most applicants will use the average monthly payroll for 2019. Yep. Okay. And that's probably the PPP loan application itself that states that possibly. And again, so there is now a document out there that's an officially published document that refers to this concept. And thank you for mentioning that. And again, the way I interpret this is, in a world where there's an official document that states that you can use the 2019 calendar year for your average costs, and there's also language out there that's been published that states that it has to be, the period of time immediately before the disbursement of the loan. And there's also language that states, for employers that have not been in business for that period of time, there's language that states how they would calculate their average. I believe that as long as you are using a good faith effort to calculate a reasonable average, that you will be in a good position to have an acceptable loan amount approved by the bank. But at the end of the day, all of this ultimately is going to be vetted by the bank before your loan is approved. So if your span of time that you use is not on the mark, the bank will let you know before your loan gets approved. So the way I would look at it right now is, if I was in the shoes of anyone on this call, the way that I did it for Checkmate is I looked at the span of time between between 4/1/2020 or 2019 and 3/31/2019. But for the purposes of our numbers are not hugely different using that span than they were if I used calendar year 2019. Again, I think that as long as you're using something that makes sense and the lender approves it, then you are in business, you're good to go, and you have nothing to worry about. But if you wanted to right now get all your ducks in a row and know what your possibilities are, I think that it's reasonable to generate numbers based on the 2019 calendar year and also based on the year 4/1/19 to 3/31/20, and see if you have a significantly different average there. And then if I were in your shoes, if people are saying, use one or the other, I would use whichever one shows a higher average monthly payroll cost so that you can get more money. So let's see, next one. If I am approved for PPL, will the government reduce my loan forgiveness by credits taken? Yeah, so I didn't include this. Okay, so that's actually a very good question. So one of the links in my presentation is a guide here that was created by the Senate Committee on Small Business and Entrepreneurship, where did my Q&As go? Sorry guys, hold on a second. Okay. Credits taken for emergency, sick, and FMLA. Okay. So basically, when we're talking about calculating, and this is why I didn't include it, because this section is what costs are eligible for payroll, what costs are not eligible for payroll. So qualified sick and family leave, for which a credit is allowed under sections 7001 and 7003 of the FFCRA. So what this means is that if you are receiving a tax credit to pay for the emergency sick leave and the EFMLA provisions of the FFCRA, then that is not money that can be that you can use PPP loan money for. So you're basically double dipping if you do that. So at the end of the day, when there's at the end after 6:30, there's sort of going to be a true up. There's going to be a look back of, okay, you had a loan amount of X dollars and you used Y dollars. The Y calculation will exclude the amounts of money that were paid for the qualified sick and family leave that you received the credit for. So that will be something that is done when we do the look back or the true up to determine how much of the loan money was used, because any of the amount of the loan money that was not used for legitimate purposes by 6/30/2020 will not be forgiven. Okay, should a company set up a separate bank account for tracking purposes of funds paid out by June 30th? Or if you can just show qualifying your totaling loan amount, that will be sufficient. So no, I do not think that it's necessary to set up a separate bank account. I do believe that it is necessary to make sure that you're going to be able to provide the reporting that will demonstrate compliance. So in essence, what we're going to need to do is we're going to need to make sure, basically any payments that are issued to folks that that are we are going to be in a position to help you with reporting that you will use at the end of the term or 6/30/2020 to produce a report that shows the amount of loan money that you actually used, and we will work with you to make sure that report excludes those payments that the loan money couldn't be used for. so that you have a good report to refer to get the to report back to the lender on how much of that loan money you actually used on legitimate expenses. But no, I do not think that a separate bank account at all is necessary as long as you have good reporting out of your payroll system. I do think that, that certain employers need to give some consideration to how you want to account for this. So, for instance, in your accounting, if you have, standard pay that is basically, coming off of the, coming from the employer, coming from your bottom line to issue payment to your employees, and you have that documented in your accounting system of coming out of account number X, when we are paying monies that are going to be ultimately recognized as forgivable from the PPP loan, you might want that to be accounted for using different account numbers. But I will defer to your, CFO or controller or whomever to determine what you need us to change about how your payroll is accounted for. But I do not think that you need a separate bank account for this. You just need good reporting in your payroll system and potentially some changes to your chart of accounts based on what your CPA or your CFO or your controller would require, given that this is actually going, you're going to be paying people's payroll costs with money that is not going to be considered income, once the loan is forgiven. So again, I defer to your accounting professionals to help us understand what we need to do to help you with that. So the New Hampshire High Tech Alliance, 501c6, yeah, that is so. Yep, and that's a question that I have right now, and unfortunately, I hear you. It does appear that the Tech Alliance, it does appear that chambers of commerce, and other trade associations are currently excluded here from the PPP, which bugs me, and I don't see any good reason for it. But that is the rule right now. I am going to look into it to see if I can't, get some better information on it. In the meantime, something that I've started saying to everybody who I'm talking to, and I highly encourage you, everyone on this call, please, 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 to the extent to which anything remains unclear for you right now, or to the extent to which you're trying to, roll with the punches and do what you need to do to get things in order, but you find yourself being hamstrung by, the government, the websites, your banker, the SBA, et cetera. Please, please, please reach out to your congresspeople, reach out to your senators. The only way that we have any possible opportunity to make things better, where this quickly enacted legislation has so clearly missed the ball on a lot of stuff, is to scream loud and to scream about it loud and clear, so that our legislators can understand where these holes are, where these gaps are. If we don't make an effort to do that, then there's no hope that you have in ever getting this made right. And I see no good reason why, a 501c6 and certain other, 501c type organizations would be excluded from this. The tax advantage nature of a 501c6 is not so significant that it would justify disallowing participation, as far as I can tell, in the PPP. But I am going to look into that, because I noticed that this morning as well. And in the meantime, I would encourage anyone who's a part of a 501c6 to reach out to your legislatures, let them know that this is a serious problem for you, and maybe we can, if it does appear to be the case that this is a limitation of the law, maybe we can get something changed in the relatively near future. Last question for now. We are just 3 W-2 employees, but mostly 1099s for a yoga studio. Is it true PPP can cover 1099s? We continue to employ them while running virtual classes. I am not aware that the PPP can be used to cover 1099s. If you heard that from somewhere, I would be interested to know what your source is so that I can check on that and get, correct myself if it is true that they can that it can be used for 1099s. But again, if we actually go back to this site that I was showing you earlier, which is, where did it go? Where did my website go? Here. So let me see. What can the loan? Okay. So employee salaries and similar compensations. It's really not specific on that. I would say that is definitely something that needs clarity here. I would say that to the extent that, 1099 wages are generally not considered salaries or commissions, certainly they wouldn't be included in those two groupings, but similar compensations seem to be kind of a gray area. So that's going to be a question that I will get some clarity on whether or not you can use the loan money. I can tell you that it does not appear to be possible to consider I do not believe that it would be possible to consider 1099 payments in the calculation of your average monthly payroll cost. Although actually, no, it says similar compensation here. So if similar compensation here includes 1099s, then it certainly would seem to indicate that it would include it down here as well. So I will look into that. I will look into that, and I will get a good answer to that question and report back. For right now, until I have indications that it could be done otherwise, I would say no to the question. However, while I'm looking into it, it would probably make sense for you to do calculations based on, including your 1099s versus not including your 1099s. And again, I will look into the specific answer to that question, and everybody on the call will receive correspondence about the answers to these questions that I've looked into based on the ones that came up that I was unable to answer while we were online here. With that said, we have, okay. So good question on the last one. Based on the communication that I received and based on the language of the website, I do not believe that there is any condition under which that would be required in order to get the $10,000 loan advance to be considered a grant. In fact, when I applied for it, it actually seemed to be saying that it was entirely grant money. Yeah, there's an email that I received that indicated it. So what I'm going to do is I'll also reply back, to everyone that was on the call with an answer to that question too, because when I applied for the grants, it was very the main reason why I jumped at it and did it immediately was because of the language that was used, in the email that I received. It did seem to be indicating that it was it was 100% going to be a grant. And then it seemed also to indicate that the expectation is going to be that you're going, most employers, if not all, are going to apply for the grant and a PPP loan. Oh, actually, let me think about this. So if you haven't previously applied for a SBA disaster loan or the PPP loan, then there is nothing that the grant could be tied to. You have to have an emergency, an economic injury loan in process, or a PPP loan that you've applied for, I believe, in order to get the grant. That said, I have no idea how they're controlling it. I have no idea how they're making sure that you do have a PPP loan application processing in order to accept your application for the grant. It might be something that they're going to check back on in arrears after they've already issued the money. So for right now, again, what I do know for a fact is that when there is a PPP loan and a grant that was given, that the grant will automatically be included in the amount of the PPP loan that is considered for forgiveness. But again, I have no idea how this is working in the absence of PPP loans. And the fact of the matter is nobody has applied for PPP loans yet, and I have applied for the grant already. So it remains to be seen on the exact specifics of how that gets converted into a grant if you don't also apply for a PPP loan. But I do know for a fact that when there is a PPP loan and the grant was taken, that the grant will automatically get absorbed into the forgiven amount from the loan. So that is the last question posted here for now. So as I said, everybody on the call is going to get a copy of the recording. Everybody on the call is going to get a copy of the presentation. I will also be including folks that were on the call in emails that go out with updates on new developments related to some of the questions that I either needed to look into or that I answered and realized there are different answers for. Some of these emails are going to come through as email blasts to all customers and whatnot, but it should be very clear to you, which emails we're sending out that include which information for you. So again, I hope that everybody has been able to glean some value from the information I provided on the webinar today. If anybody needs or wants to have a direct conversation with me about anything that's on your mind related to the CARES Act or FFCRA or anything in general to do with furloughs or layoffs, please email me and I'll be more than happy to set aside some time to talk with you. Please also, give me a bit of time here because, there are many of you that are that need some attention right now, and my goal is to not exclude any of you from having that attention. But there's only so many people I can talk to at once. So that all said, do tune in to the webinar at Friday at noon if you can. We will also record that webinar as well. These recordings of these webinars will be posted up on our webpage, which I'm hoping will be live anytime now, probably not sooner than the later part of tomorrow, but possibly by then. These recordings will be up there. The FAQs for each of these, things that we're dealing with, the CARES Act and FFCRA and whatnot, will also be on that webpage as well. So you should be able to get the resources that you need from us, even if I'm delayed in calling you, if you've asked for a phone call or an email response from me. So that all said, again, the last thing I want to leave you with, guys, is that we are here to help. We are here to do what we can to keep your heads above water, to do what we can to set your minds at ease about, what's to come based on what we know about, the next, number of months related to the PPP and things of that nature. And we do very much value your business. We are right now, there is nothing that we're doing for any customers that we are currently assessing additional fees around. We will reflect back on this here in the next month or two. once we realize what we're really in for the processing of the tax credits and things of that nature. But for right now, nobody needs to worry about additional costs from us or anything like that. So if you need any additional help, if you need any additional resources or support, please just reach out to your CAM, reach out to me directly, or one of those avenues, and we will do our best to make sure that you get our attention where you need that attention. Thank you, everybody, for dialing into the call today. I do appreciate, the questions. I do appreciate your interactions, and I hope that this was beneficial. With that, I'm going to end the call. Oh, hold on. We have one more. I think that might have been submitted. Nope. Okay, so we're going to end the call. So thank you, everyone. Take care and stay healthy.